Bao this morning. Good morning to you. Equity futures right now down 0.6% on the S&P, on the Nasdaq down 0.7%. Do you remember all the recession talk to close out 2022? And then January happened. 517,000 on payrolls, unemployment at 3.4%, and retail sales climbing the most in nearly 2 years. That was 40 minutes ago, an hour ago. Just stellar stuff. Equity futures softer going into the open because of this in the bond market. Switch at the board and get to the bond market. Yields look a little something like this. Higher by 4 basis points, 378.18. Your 2-year very close to 470 a little bit earlier, backing away from those levels. Your 2-year right now is +2 to 463. Your dollar a bit stronger against the weaker euro. Euro dollar 106.75. We're -0.6%, and crude -0.8% at $78 and let's call it 40 cents. 30 seconds into the session, equities look like this. -0.6 on the S&P, on the Nasdaq down 0.5%, just a bit softer off the back of better data, pushing yields even higher and sparking that conversation. More fuel for it that this cycle gets extended and yields have got to go higher because the Fed has got more work to do. One stock to watch at the open, Airbnb, issuing a better than expected forecast with its high number of active bookers on a record. That stock is up by more than 8%. The company's saying, quote, it demonstrates our guests' excitement to travel on Airbnb despite evolving macroeconomic uncertainties. I love that corporate speak, evolving macroeconomic uncertainties. Mandeep Singh, let's make it simple. They got it done, didn't they?
They did. And look, I think when you look at the execution in terms of coming out of the pandemic, they were strong during the pandemic, but coming out, they look even stronger. So the top line growth as well as operating leverage actually stands out from all the marketplace peers. I mean, we talked about Uber and Lyft last week, how they're looking to show operating leverage. In the case of Airbnb, I mean, this company has 25% plus EBITDA margins, and at the scale that they're operating, I think this is probably the best looking marketplace business out there right now.
Mandeep, what is going on with travel? The airlines before today's session, the airlines up aggressively. United up 33%, American up 32%, Delta up more than 17%, Airbnb doing well, Uber doing well. What do you make of all of this?
Yeah, look, and even the hotels, I think Marriott and TripAdvisor, they reported all of them are benefiting from this pent-up travel demand. And look, this isn't a 1 or 2 quarter thing. I think it's going to probably remain at least for the first half. The only concern I see is maybe there could be an uptick with cancellations if people decide, you know, they don't have enough money to spend. And we haven't seen that so far, but that was the only kind of metric in Airbnb's print where they talked about cancellations going up and the room night growth sort of decelerating. But right now we see no signs of travel actually coming down.
Mandeep, post-pandemic, if it was 12 months ago, someone would have said to you and I, this is revenge spend, it won't last, the Fed's going to be hiking interest rates, here we are 400 basis points plus later. Do you see any sign, any evidence whatsoever that things are slowing down?
Actually, so you have to go by geography. I think U.S. domestic travel was very strong over the last 1 year, and it probably will continue for the next few quarters. Internationally, it wasn't such a big lift for all these companies, and that's where if China outbound travel really rebounds sharply, that could be a big tailwind for all the travel companies.
Mandeep, what a move. Airbnb up more than 10%. Appreciate your time as always. From Bloomberg Intelligence, Mandeep Singh up 10.3% on Airbnb, closed there. Biggest daily gain going back to May 2022. Keeping an eye also on the semis. Chip stocks falling after Berkshire's 13F filing shows the firm slashed its TSMC holding by 86% last quarter. Abby has more. Hey, Abby.
Hey, John. Well, everybody loves to watch what the Oracle of Omaha, or Warren Buffett and Berkshire Hathaway, are doing. And what Warren Buffett did in the third quarter of last year, hedge funds piled in for the fourth quarter. But what Warren Buffett also did in the fourth quarter was to sell a big part of that TSM position that was acquired in the third quarter, really creating the idea that they're early fast money. I've never thought of Berkshire Hathaway that way, but in the third quarter they did buy 60 million shares for $68.33. They sold the bulk of that position in the fourth quarter for a roughly $500 million profit. Meanwhile, some 68 hedge funds piled into Taiwan Semiconductor in the fourth quarter. Renaissance Technologies included buying roughly 7.6 million shares. Now this, of course, ahead of this this year's big rally of up 23%, leading some of those other technology stocks. Somewhat baffling in some ways, John, given the fact that we've also had yields back up. But it does support the idea that you've been talking about all morning and in recent days, this idea of a no landing. But when we take a look at chips and Taiwan Semiconductor going back to last year, well, it's interesting because this rally really has been building. Taiwan Semiconductor out of the November low up 53%. We have the chips up out of the October low up more than 44%. Big buying power here for the chips, which could be a good sign, again, for the idea of no landing, given the fact that they are an early tell for technology. It seems like a lot of the supply chain kinks have worked out and demand is decent.
Abby, thank you. On the latest, we keep hearing that phrase, don't we? No landing. Been talking about that for weeks, and credit to Neil Dunter of Renmac for being on top of that story as we closed out last year. Equities right now on the S&P down 0.5%, about 5 minutes into this. On the Nasdaq down 1/3%. Your scores year to date, and bear in mind we're only halfway through February, we're still up 7% on the S&P. On the Nasdaq year to date, we're up about 14%. Do you remember the consensus view on Wall Street coming into 2023? It was first half dip and second half rip. Well, now it's first half rip and maybe even a second half dip. The consensus on Wall Street falling apart. Investors taking sides. Chris Harvey of Wells Fargo calling time on the bear market. Morgan Stanley's Mike Wilson saying we haven't seen the bottom yet. And Bank of America's Savita Subramanian saying this.
The S&P 500, we could remain in this bear market for a while because we're in the process of right-sizing tech and everything else kind of getting bigger in the benchmarks. And that's not going to be a great environment for the S&P 500.
Nadia Lovell of UBS echoing that view, saying the following. There's more cuts to come to forward earnings estimates. The risk reward is not compelling and we expect the market to correct. Nadia, I'm pleased to say, joins us right now. Nadia, you've seen the year-to-date gains and thanks for being with us. Up 7% on the S&P, on the Nasdaq up 14%, and all of a sudden, a month and a half into 2023, the equity market sits on top of your year-end price target. What are you advocating for now?
You know, we think that is on the higher end of that scenario. We think that this tug of war between hard landing, soft landing, and no landing is probably going to continue for most of the first half of the year. Right now, the market is choosing to look through the inflation data and more focus on the current economic growth data, which has been fairly resilient just given the strength of the consumer. But we think that this market is going to pull back. I mean, some of the factors that has really driven this market year to date is starting to show exhaustion. You know, systematic position is a little bit more balanced now. The short covering peak is behind us, and we think that the earnings picture still remains in a deteriorating downward revision cycle. And when you look at valuation, you know, valuation is now extended, and so we think that that's going to be the resistance. The bond yields are moving higher. They're reflecting that higher inflation risk and the Fed reaction function. So it becomes more difficult and challenging to argue for further multiple expansions. And so this is why we continue to maintain our year-end price target of around 4,000 for the S&P 500.
And Nadia, aren't those higher yields also reflecting better hard data, retail sales and payrolls? What does that mean for the equity call?
Yeah, you know, I think near term, it can help support the market near term, but we do expect that data to start to deteriorate. Yes, the consumer excessive spending and excess savings are lasting a bit longer, but we think that as you start to feel that drag of monetary policy, I mean, right now the market is pricing in a Fed funds rate that's above 5%, and it could go even much higher than that, depending on if the labor market remains excessively strong and we see upward pressure on wage growth. We know that Chairman Powell has said that, and we know that in the December dots, like most of the members skewed very hawkishly. So we think that ultimately what's happened is that you had a pull forward of the returns that we had expected in the back half of the year, in the first half of the year, but we think that that will correct itself as the year progresses.
Nadia, not for me to say that you'll be wrong, but I'm just wondering what would make you change your mind. How many more payrolls prints, how many more retail sales numbers like the one we got this morning would it take for you to change your view?
I think what we need to see is that we need to see wage growth contained. We need to see that the Fed pauses, right? We still don't know when exactly the Fed is going to pause. We need to also see a bottoming of the earnings downward revision cycle. If you look at some of the forward indicators, John, the forward indicators are really pointing to more risk ahead, whether that is the ISM manufacturing, the senior loan officer survey, and the new orders are all pointing in that direction. So we just think that is a matter of time before all this correction happens. You're already seeing in the downward revision cycle that's happening in the market. The market is just choosing to ignore what is actually happening under the hood in terms of earnings growth.
Earnings weren't great. These bond moves go against what we've seen in tech. I'll go through it piece by piece. I think we bottomed on the 2-year in early February, just north of 4%. Since then, we've had a move of more than 60 basis points, and this equity market has hardly budged. I'm looking at some tech names. Nadia, Meta up by close to 50% year to date before today. Tesla up 70%, Apple up 18%. Is everyone just crazy, or is there something in this? Is there something to learn from what we've seen so far year to date?
No, I would never say that everyone in the market is just crazy. I think what you're seeing is some companies are rewarded for improved efficiency. That's going to have better potentially free cash flows going forward. But it is perplexing to see the rally that we've seen in tech so far, just given the move up in bond yields, and the outlook remains deteriorated. That normalization process is happening in tech. When you look at some of the semi names that are really rallied, you're seeing the continued weakness in PCs. You're also seeing this weakness also in high-end smartphone. You're actually now starting to see price cuts as well, particularly in PC chips as well as networking chips, and that has implications for margins going forward. And it could mean that for some semiconductor companies, you could see margins that come down below the pre-pandemic levels as well. And then when you look at software, like the cloud, that's decelerated massively. I think you're also seeing some excitement more recently around AI and machine learning. And of course, yes, that's exciting, just given the implications going forward for the technology. But it also likely means an increased intense investment cycle ahead, and that's going to have implications for margins as well as cash flow. And even though with the rally, when you look at where consensus is for tech on terms of earnings, it's in line with the market, but tech is trading at a 30% premium to the market. So we think eventually that valuation premium is going to correct and come back towards that longer term average is around 10% premium.
Nadia, there are things you like. If memory serves me well, from the last time we spoke, EM, China, German equities, are they three flavors of the same thing?
They're interrelated, of course. Some of this has to do with China reopening much faster and stronger than expected. That has implications for Europe. We're also seeing that, of course, Europe is getting some reprieve from the lower energy prices given the warmer winter in Europe. We think that the Chinese consumer is going to be traveling extensively. As you noted earlier in the segment, there's a pickup in travel, and we think that that's going to only intensify as the Chinese consumer travels this summer into Europe, and that should be a positive. Also, Germany is an export-driven economy, and so any sort of incremental pickup in demand from China is going to be beneficial to German equities.
Is that enough to offset the deceleration you expect in the U.S.?
Right now we do prefer, as you noted, in terms of our lineup, we do prefer ex-U.S. versus U.S. We don't think that, we do think ex-U.S., of course, like China will be enough to offset some of the drag from the U.S., but we still continue to think that the U.S. economy will enter a recession either later this year or early next year, just given the I hate to use the term that you've been using all morning in terms of the variable and long lags of monetary policy. We think that ultimately that is going to come to fruition as we head into 2024.
We'll see how long those lags are. Nadia, thank you. As always, just brilliant. Nadia Lovell there of UBS. But two ways of looking at this. Not for me to tell you how to look at it. One way, you can just sit here and say there are long and variable lags. The work the Fed has done over the last 12 months will hit the economy eventually in a more material way. Or you can draw the conclusion that this Fed has not done enough. And Neil Dutta of Renmac has been pushing that story alongside Torsten Slok of Apollo and others. Equity futures were negative going into the opening bell. Coming out of it about 13 minutes into the session, we're down by 1/3% on the S&P. On the Nasdaq, we're down 0.2%. Maybe not the drama you expected after retail sales. Yields a little bit higher throughout this morning. We are now dead flat unchanged on a 2-year after coming very close to 470. Right now, your 2-year 461. Coming up, the outlook for crude just got a little bit more constructive.
We will be worried more about from where the supply is coming rather than the demand. I'm not worried about the demand.
That conversation up next.
hopefully by end of this year we'll recover more, and trust me, we will be worried more about from where the supply is coming rather than the demand. I'm not worried about the demand. I think what worries us is, are we going to have enough supply in the future?
Demand concerns clearing up for crude. Now it's about supply. The IEA boosting its global demand forecast, writing the following: China's reopening will give a welcome boost to the listless world economy. The country is set to resume its established role as the primary engine of world oil demand growth. I'm pleased to sound this story. Alex Longley joins us now. Morning, Alex.
Good morning. It's been quite the catch-up from the IEA. The market has really been talking about this China boost for a little while. A 500,000 barrel a day revision to the global demand forecast for this year. That's a pretty chunky move, and it tells you something about the second half of the year. Traders for a long time have been pretty optimistic about how things are going to look. Pierre Anjurand, one of the market's top hedge fund players, saying basically the second half we can look for prices ripping up towards $140 a barrel. Goldman Sachs have been saying that for a little while as well. Against that, what you need to remember is for the moment prices aren't doing a whole lot. We've been trading in a $10 range for much of this year, and this is something that's really carrying forwards into the second half that traders are looking for and analysts are looking for. Is the demand recovery in China going to be enough to pull the crude price with it? Certainly, having just come back from Hong Kong myself, it seems as though the reopening is real, and I think what traders are looking for now is to see a sloppy first quarter crude market be tightened up by that China pull as we come into the second half, John.
Alex, how conservative do you think OPEC's going to be in the meantime?
I think everything that we hear from the member states and my colleagues on the OPEC team, it doesn't sound like there's any plans for production movement anytime soon. The Saudi energy minister for a long time has said he's going to wait and see demand before he acts upon it. And that was a key theme last year when, again, there was talk of higher levels of demand and it never quite materialized. So I don't think you're likely to see OPEC making any sudden moves in anticipation of a demand surge in the second half of the year. They're going to be reactive to that rather than proactive.
Alex, thank you. Alex Longley on the oil story. Let's extend that conversation with Jack Fauci of Bloomberg. Jack joins us now. Jack, it's always great to catch up with you, sir. Just frame that a little bit more for us, where this leaves OPEC Plus and how they are responding to the criticism they got from this administration going into the midterms just a few months back.
Well, I think with hindsight, it looks like they were taking a fairly reasonable action. You know, they cut production. Actually, oil prices have come down. They've been trading in this kind of fairly range-bound area. We've seen energy prices across the board, not just oil, but also gas and coal have come down, and the world is breathing a little easier at the moment than it was a few months ago when you and I last spoke, John. I think there's this dynamic which Alex highlighted playing out across commodity markets at the moment, which is everyone is looking ahead to what China's reopening is going to mean for the global economy, and it's a really strong picture. It's quite hard to see where the supply of a lot of key commodities, oil is one of them, but I mean you could also look at gas, at metals, and it's quite hard to see where the supply at some point is going to come from. But right now you're trading the markets today, and there's still plenty of supply today in quite a lot of these markets. So in oil, for example, the story is Russian supply has not fallen nearly as much as some people expected it would do, and so the markets are looking relatively well supplied today, but people are worrying about what's going to happen in a few months' time.
We're pricing today also the investment decisions made 5-10 years ago. Jack, Alex mentioned the Goldman call. Jeff Currie, you remember that line from Jeff Currie in the last 18 months or so? It's the revenge of fossil fuels. Jack, we've come into 23. We've drained the SPR here in America. You can hear some officials in OPEC Plus really kind of flashing the light, waving a flag saying we might have a problem here on the supply side. Jack, do you think we might? Can you give us a little bit more information on that?
I think we certainly might. Listen, we've already had the problem on the supply side, right? Like last year, across a number of commodities, most obviously gas and coal, but also oil. Remember, oil prices got to $139 last year. We've had a supply side issue already. We've had extreme increases in the price of energy commodities. Today, it looks slightly better, but if we have a strong global economy for a few more months, for the rest of this year, we have China growing strongly, I think very soon we're going to be having that conversation about underinvestment in the supply side, not just in oil, but also across the energy spectrum, across metals as well.
Well, copper's absolutely ripped as well. That's a story maybe for later this year too. Jack, awesome as always. Jack Fauci, just reminding us that we saw triple-digit crude last year. And remember, we did that with China locked down. Let's see how that demand clicks in a little bit later this year. Brent crude down about 1%, 84.67. WTI down about 1% also, $78 and about 17 cents. 22 minutes into the session, we pulled back a bit by 0.4% on the S&P, and the Nasdaq down 0.2%. We've been focused on the front end of the yield curve for the last 24 hours, for sure. Your 2-year came really close to 470 a little bit earlier on, 469 off the back of a much stronger retail sales print. Big upside surprise. It's backed away since then, 461 on a 2-year. Let's get you some sector price action. Here's Abby.
Hey, John. Well, that weakness in oil that you were just talking about, it means energy right now is the worst sector, down about 2%. But what's so interesting, we're looking at a roughly 0.4% decline for the S&P 500. Very low volume, 20% below the 20-day average. But yet all sectors are lower. So lots of small declines right across the board. Over the last month, though, John, it is a big difference. It's much more of a risk-on picture because over the last month, we have hardware and equipment technology up about 11%. We have the chips up 11%. Energy, though, it is down over the last month. And then take a look at utilities, down 5%. That, of course, has everything to do with yields higher, making those dividends look less attractive.
Abby, thanks for that. That's the latest on the sector price action. Up next, your trading diary. Retail sales in America jumping by the most in nearly 2 years. 25 minutes into the session, equities pulled back by 0.6% on the S&P, on the Nasdaq down about 0.5%, taking a small bite out of a decent year-to-date gain. And the bond market yields have been pushing higher over the last couple of weeks. We came this close to 470 a little bit earlier at the front end of the curve. The 2 years backed away since then. Right now, on your 2-year, basically unchanged at 460.96. That's the price action. Here's the trading diary. Coming up, President Biden discusses the U.S. economy at 2:30 Eastern. Earnings coming up from Cisco after the closing bell, plus another round of jobless claims and US PPI on Thursday. And finally, more Fed speak. Mester, Bullard, Kirk, Barkin, Bauman to close out the week. That closes out the day for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Experts, great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, February 15th. Here are the top market stories we're following for you at this hour. Slowdown? What slowdown? Retail sales crush estimates, jumping the most in almost 2 years. Are we in a good news, bad news situation? Equities lower, bonds pretty confused. And higher for longer for real this time. Markets mostly priced out cuts for this year, finally believing the Fed. We try and find out just how far the central bank's going to have to go. And the next gold rush, maybe. We talked to Mark Bristow, CEO of Barrick Gold, and his expansion plans after output hits a 22-year low. That stock down over 3%. From New York, I'm Alex Steele with my co-host in London, Danny Berger. Guy Johnson is off today. Welcome to Bloomberg Markets. All right, Danny, you don't know this, but I've been put on a budget. So I have a weekly budget now, which was not a thing in 2022. So I truly expected retail sales to feel the pinch from my lack of shopping, and I was actually a little bit shocked that that didn't happen.
I love this idea, Alex, that you're such a big contribution to the American retailer. If you're not a bellwether, then I don't know what is. But look, the Fed speakers couldn't get this market to move, but that data certainly did. Coming in at 3%, expectations for retail sales was 2%.
Yeah, and I wonder what we adjust for inflation, and I also wonder if we're supposedly spending even more on services that really aren't accounted for in the data, except for restaurants and bars. How much more are we actually spending? It is interesting to see how the market actually responds, like maybe we're believing the Fed, and the other data coming in strong also. It's like, are we going to have to start really believing the no landing scenario?
Yeah, I have to say, Alex, it feels like something has shifted in this bond market, though you don't even just need to feel it. You can see it. Cuts being priced out. The entirety of the curve has moved. I think it's extremely significant that at the moment, Alex, 2-year yields are down. It is duration. It is the long end of the curve where yields are up. It is this inflation is here to stay. It feels like that is what's getting priced in finally.
Yeah. And then if you're not going to see some kind of uber recession, then how do you price in cuts at all at the end of the day? That higher for longer scenario.
Well, which gets us all, Alex, to our question of the day. Where is the Fed's finish line? The market at the moment pricing in about 5.5% terminal rate. Is that the finishing line? Does this data tell us it's even higher? Joining us now to try to answer that is Bloomberg's Michael McKee and Kriti Gupta. Mike, let me kick it off with you. This hot retail sales data, the consumer is in better shape. Does the Fed need to take it up another notch?
Well, they may, and that's the thing about it is they don't have to decide until March 22nd what their next move is, and then they'll have another 6 to 8 weeks before the following meeting. Markets are pricing to data that's out today. The Fed has been saying all along that it is going to raise rates further. The question is, how fast do they stop doing 25s and do 50 again, and how far do they have to go? The forecast for 5.1% that they had was made on December 14th, and there were 7 of the 19 who said that it would be higher than the 5.1%. So wouldn't take much to get a 5.5% or something like that estimate out of them. It'll depend, though, on how the data go over the next couple of months. Now, the thing about it is nobody really knows what the neutral rate is, where they want to get to. It's something you can figure out in hindsight, but it does look like it has moved up. Bruce Kasman at JP Morgan publishing today, their work is the neutral rate has moved up, which just means the Fed's going to have to do more work.
Were you surprised, Mike, that my numbers didn't reflect retail sales?
Yeah, I did a chart of retail sales ex-Alex.
And they should have been down.
And they should have been down. But
I can't believe the guy's not here to make fun of me for this. So, Kriti, I'm puzzled, the market reaction. What do you make of it? Is this us repricing the terminal? What do you think?
Yeah, you, me, Mike McKee, we're all puzzled.
I mean, right at 840, I understood the market reaction. Now I don't.
Yeah, it's interesting. I'm going to start with the stock market here because the bond market, to me, I think is a little bit more kind of technical focused. I'll get to that in a second. But the equity market, there's a few theories out there, and I think this is really important when we talk about what the market is actually pricing in. You heard Mike talk about perhaps them hiking even more. So that when you look at the Fed funds rate, I believe is now looking at somewhere at 5.5%. in theory, that should send stocks much, much lower than I think about 0.5% that they are off right now on the S&P 500. But there's a few theories out there. One is that because of the carnage of 2022, a lot of this kind of macro-driven story is kind of priced in. And I hate to say that, but it feels like the equity reaction is muted relative to what, in theory, it should be. The other reaction here, and I'm just speaking to Jess Menton over on Equities team about this, we've kind of been brainstorming to make sense of this market reaction, is that if you look at the way the sensitivity that a lot of these hikes have been priced in, there might be this idea that, well, if they go higher for longer, then they don't have to pause and restart the way they do in the 70s. So essentially not pricing in a policy mistake, and that might be considered not necessarily a good thing, but a not as bad thing as previously thought of. So that is just once again, one theory put forward. But Alex, the stock market is a little bit puzzling. The bond market is a little bit more straightforward. That is the 10-year yield specifically. We're at 375 right now. That's a purely technical level. So just bouncing between that.
Okay, so maybe a little bit more rationality in the bond market. Alex, I was also actually just wondering, you know your monthly budget, is it inflation adjusted? Perhaps that is the root cause of this, of why it's not coming through.
No, but good question. I was like, is it? Should it be? I had to like really take a moment for that. But no, it is not. It's not just clothing. It's for everything. It's for discretionary stuff too. And
all right, there we go. Okay, fair enough. Look, okay, so Kriti, back to the bonds, back to shopping for bonds. You know, okay, 10-year perhaps more of a mechanical level, but at one point we did have a curve that was inverted to -90. Yeah. Really extreme stuff there, but again, the consumer is strong. How much do we actually keep trusting this as a recessionary signal? Is something broken here?
It very well might be, and I think this is something that we've been talking about for a while, that do we really need to look at the 2s10s as the kind of indicator of that recession, given that the front end of the curve is so tied to the Federal Reserve. That being said, it also feels like part of the narrative is this idea that Torsten Flock, by the way, over at Apollo Global Management, was way ahead of the curve on. He said, look, there might be a no landing scenario, and as you look at a consumer that can weather this, and by the way, you're not just seeing this in retail sales, you're seeing this in corporate stories as well. Look at Airbnb earnings, look at TripAdvisor earnings. They're saying demand is basically unquenchable at the moment. They're still looking at record years when it comes to the travel space. Kraft Heinz, for example, reporting this morning saying the same thing that PepsiCo and Coca-Cola did, that we're raising prices and consumers, pun not intended, are still eating it up. And that's really, really important when you talk about just how strong the consumer is. So there is a scenario that is more actively being priced in the markets, that maybe that recessionary call that drove markets in 2022 isn't really a factor anymore, because we could get out on the other side of this and be just fine.
The interesting thing, though, is that we have seen recession indicators, the recession forecasting indicators that people put out, still calling for recession, but maybe the 10-year yield is now reacting to the idea that instead of recession, they got to price in a rebound, a stronger economy with lower inflation. In other words, the Fed wins. That's hard to tell. But when you look at Jay Powell's favorite curve, which is the 3-month, 18 months out, it has come back a little bit. It was inverted almost by 100 basis points, and now it's 47. So there is some improvement there. The question is, are they thinking like the Fed, that they're going to win over inflation, or are they thinking that we're going to see a recession?
Right. I have no idea, and that's why we brought you guys on. Guys, thanks a lot. Mike, Kriti, really appreciate it. Thank you both very much. And be sure to tune in to the David Rubenstein Show later on today, peer-to-peer conversations. It's tonight on Bloomberg Television. It's going to feature a sit-down with Fed Chair Jay Powell at 9 p.m. New York time, so stay tuned for that. And coming up, more of our question with the day, where is the Fed's finish line? How do you invest? Margie Patel, Allspring Global Investments Senior Portfolio Manager, joins us. This is Bloomberg.
I think what was interesting about the January sales number, obviously it was very strong. You looked at apparel, you looked at furniture, they showed strength also, in addition to a big uptick in restaurants. Keep in mind, I don't take January as seriously as I take March, April, and May. January is about clearing out promotional and clearance goods.
That was Dana Telsey, Telsey Advisory Group CEO, reacting to those January retail sales number, which brings us back to the question of the day. Where is the Fed's finish line? It looks like we're finally pricing out cuts for this year. So let's get the insight here with Margi Patel, Allspring Global Investments Senior Portfolio Manager, joins us now. Margi, where's the Fed's finish line now?
Well, I don't think the Fed knows any more really than we know. They've indicated repeatedly they're looking for signals from the marketplace, which makes them look pretty much like the rest of us looking at the market, trying to figure out the direction of rates and the economy. But as we can see, the economy is still pretty resilient. Consumers are in good shape. Unemployment is still very low. So it doesn't look like over the short term we've had a lot of immediate effect of that huge increase in short rates that they've made. So that says to me it may take the Fed a little bit longer, and it may take much longer to get to that promised land of 2% inflation, which they're hoping to hit sometime next year.
So, Margi, the Fed doesn't know, you don't know, I certainly don't know. In that sort of environment where everything is just so uncertain, everything is, as the Fed loves to say, data dependent, what becomes your North Star investing? What becomes the thing that you follow in this uncertain regime?
Well, I think a few things. I think number one, it says to me that rates are going to be significantly higher than the wonderful zero interest rate period that we've exited from. So we're putting more emphasis on more moderately price earnings ratio stocks. In fact, price earnings have actually increased from a low of, say, 17 times last year. We're almost all the way back up to 20 where the Fed began to tighten. So we're looking for more moderate PEs, and also we think dividends are going to be a little bit more important in valuation. And companies that have some sustainable growth path.
So, Margi, that all makes sense to me. So why do stocks continue to hold up? And I appreciate the Nasdaq's down by 0.6%, but compared to what we may see from the Fed and the data that we saw, I'm surprised we're not down more. I don't get it.
Well, I think it's really a short-term reaction. If you look last year, around mid-year, around May, we had the NASDAQ really go off a cliff, and we had the Dow Jones and more value-oriented sectors really rocket up through the end of the year. And what we've had since the beginning of the year is a reversal of that, where NASDAQ has charged ahead, and the Dow Jones is up modestly, and Standard & Poor's right in the middle. So to me, that's just a short-term reaction, maybe a little bit of oversold, overbought, rather than looking at the fundamentals. And right now, I think the market's still looking at the Fed rather than looking at the outlook for earnings growth, which looks pretty modest.
It looks modest, but the bigger macro data, Margi, we have retail sales coming in really strong. Does that tell you anything that perhaps corporates will be better off, especially consumer-facing ones?
Well, I think it tells you that, as I said, the economy's in good shape, and after all, the government spending pumped in trillions of dollars over the last couple of years because of COVID, so there's a lot of strength in the economy, a lot of liquidity. So that says to me the economy is not going to be all that sensitive to modest rises from here in interest rates, and the effect of these higher interest rates. There will be a lag effect, so we're still in the good part of that curve of higher rates, but everybody's in good shape.
Okay, Margi, so what do you buy in that environment? I mean, everyone's going to want the dividend payers and the high-quality companies. Everyone's going to say that. But how do you figure that out?
Well, looking more at sectors, I think, is a better way, because we can have a better grip on earnings. In the technology space, we still like the semiconductor space, even though they've had huge moves. They have, actually, many of them have very attractive dividend yields. We think we may not see the bottom in that sector till maybe close to mid-year as they work off inventories, but then we think the growth will pick up, so we like that sector. We still like the healthcare sector, especially the tools and devices, which really have taken a back seat because we've had the COVID boom kind of go off, but we still think they have a lot of secular growth from innovation and new products. And we also like some of the industrials, because we think we're on a long-term rebuilding of the U.S. industrial base, so we like those sectors.
While yields have moved up everywhere, we're looking at a 6-month T-bill right now that's just under 5%. You compare that to an S&P earnings yield, which is just over 5%. How attractive is cash right now? Does it have a bigger place in your portfolio, just given that yield than it usually does?
Well, I think it tells you, actually, usually when you have such an inverted yield curve, it tells you that 9 times out of 10 we'll have a recession, so you can't ignore that possibility, even though the numbers look pretty good for the economy. But also, that's a short-term move, and I think you have to just take a little bit longer-term view about where do you want to be, what companies do you want to be in, what interest rates you want to be in, and give up the yield of the very, very short part of the curve and say, I'm in here for the long term, and you never really catch the bottom. So we'd rather be in long in the right sectors and catch the rebound maybe at the end of next year.
So maybe cash kind of trash-ish. Margie, thank you so much for joining us today. That's Margie Patel of Allspring. Now, coming up, Barrick Gold posts its lowest production in more than 2 decades. Shares moving down on those results. We're going to talk more about the struggles facing gold miners with the CEO of Barrick, Mark Bristow. That's next. This is Bloomberg. All right, Barrick Gold shares, that was tricky, are down today following the release of its fourth quarter results. So the company is looking to reverse a slump in output. So its annual production last year is at the lowest in more than 2 decades, and now it's trying to reverse that for this year. Let's get the insight now from President and CEO Mark Bristow. Mark, good to see you. Investors didn't like something that they saw. What do you think was a disappointment in terms of production?
No, I don't think there's anything that's a disappointment if you look at it. You know, we came in slightly above consensus as far as our financial numbers go. Barrick's in good shape. You know, we're not about how much gold we produce, it's how much profitable gold we produce. We're certainly guiding back to the same guidance that we put in this year. We did have a softer production out of Nevada, but that's not a long-term trend at all.
So, Mark, to that point, if you're going up to the high end of production would be 4.6 million ounces this year, I'm just really interested as to what would prevent you from getting there. Labor, sticky costs, has all the good stuff already been mined? Like, what is the biggest inhibitor to that goal?
Yeah, so remember, mining is a long-term game, so it's not about just this year. It's about what do we look like in 10 years' time, and I think it's worth going back to when we announced the joint venture with Randgold. We set ourselves some targets. We produced 19 million ounces. We've replaced all those ounces plus more through the drill bit. So we have grown reserves. We've really delivered on the synergies in Nevada. It's a very big foundational value proposition for us in Nevada. We've cleaned up our portfolio, again focusing on tier 1 assets, and so, you know, midpoint is 4.2 million ounces. That was our target this year. This past year, we need to get back up there, and we definitely have the assets to be able to deliver against that.
Mark, I mean, really simplistic here, but what is the hardest thing about mining right now in this environment?
Well, when you wake up in the morning, you got a few challenges, and then you have a couple more in the afternoon. That's mining. I think the key one is really, you know, my focus is building real value. So growing this business on the back of tier 1 assets, whether it's copper or gold, high quality assets, long life assets. And, you know, one of the things we've done in the last 4 years is strengthen the financial component of Barrick, and we've been recognized with Moody's regrading us to A's, the best grading in the, and with a stable output, the best grading in the gold industry. We've also replaced all the gold we've mined. We've got very little debt, strongest balance sheet in the industry, and we've deployed our exploration teams, and we really are well equipped. And today we actually announced a significant intersection in our 4 Mile project in Nevada. It's a 100% Barrick asset, and really we think that's the first sign of a new discovery in that project. So we are investing in our future. That's what mining is about, because it's a consumptive industry. If you don't invest, you have to buy.
Yes. No. Yeah. We'll get to that buying in just a second. I just want to go back to the share price, Mark. I get it. I get that you're long term. I totally get that part. But the negative free cash flow issue. Investors are unhappy about something. How do you fix that, though, in the short term? Can you produce enough to offset the rising costs, for example?
So again, just coming back, you know, I know that your show is all about today, but mining is not. And so, you know, the share price will go up and down, not necessarily in that order, but over the long term, we deliver long-term value. And again, we've steadily rebuilt Barrick's profile in the market. We've got a solid register. And of course, we want to see this share price go up. We think we are undervalued relative to our peers. We've been, last year, bought quite a bit of shares. We bought our shares back because we felt they were undervalued. So, you know, we are focused on that, but it's a considered approach. There's no magic in winning over the market for the long term.
Well, let's talk more about buying stuff. Mark, I really like a quote you gave earlier this month saying that there's a difference between a value merger acquisition and getting bigger for just the sake of getting bigger. This was, of course, in response to not making a rival offer for Newcrest. So you didn't like that deal. Do you see any value merger acquisitions, as you put it, in the market right now?
Not right now. You know, we've certainly, as you know, participated in a lot of these transactions as far as the due diligence and evaluation of them. But you know, we built the new Barrick on the back of 3 big mergers, all at market, and we've been able to deliver against those strategic objectives. And again, you know, we've built our ability to invest in our own future. You can see that because we replaced all the reserves that we've mined again this year, and we have replaced all the reserves that we've mined since the merger. So we're in very good shape, both financially and productive-wise. We're guiding a 1 million ounce equivalent growth over the next 2 years organically, and we will continue to deliver a growing free cash flow profile, which will support our dividend over the long term. This current year is a year where we've got quite a bit of capital. We are going to invest in more mining fleet, and so that does impact on the cash flow.
Yeah, because you got to invest or else you buy, which, to your point, if you're going to invest, then you're not going to do the buying. What about in copper, though? You're becoming a pretty significant copper producer. That is like the metal, one of the metals in the energy transition that we're undergoing here. How do you beef that up when reserve lives can be a little dicey for copper?
So for me, you know, again, when you look at our copper investments, Lumwana we're doing a pre-feasibility study this year, looking to increase its life of mine by 60 years. So that's a significant, and to increase its production profile. And Reko Diq is a world-class copper mine. It's currently estimated life of mine is 42 years. We expect it to go way beyond that. Okay. So those are the foundational building blocks of our
Mark, I'm just going to have to jump in here. Unfortunately, we're just out of time. Really appreciate you joining us today. Mark Bristow, Barrick President and CEO. Coming up on the program, it may take a while for Elon Musk to hand over the CEO role. This is Bloomberg.
We're about an hour into the U.S. trading session. Really strong numbers from retail sales. Stocks a little bit softer, but I would have expected that good news is bad news for the equity market to be a much stronger theme. Abigail's tracking these moves for us. Abigail?
Yeah, to your point, Alex, we're looking at modest declines, not the fearful declines that rates are going higher and that's going to press on stock valuation. We also have an interesting tension between those hot retail sales and Arneem Holzer over at EAB Investment Group talking about the idea that capacity utilization, industrial production a little bit light, so this divergence between on the industrial side and the consumer. The NASDAQ down a little bit less, down about 0.4%. Now, of course, one stock weighing today, Taiwan Semiconductor, Warren Buffett's Berkshire Hathaway reduced the bulk of their position that they took on in the third quarter. In the fourth quarter, this is 67 hedge funds got in on the stock at that time. Net, it's up more than 60% out of the November low, but today some is coming off. Oil a little bit lower too. As for those retail sales, it was strong right across the board. Really making the case for what so many people have been talking about over the last week or so, or this idea of not a soft landing, but no landing. Take a look at vehicles up 5.9%, gas stations, goods, department stores, net up 3%, very strong. Now this, of course, does support the idea that the Federal Reserve is fully in hiking mode, as they've been saying for some time, but market participants are now more on board too. If we take a look at the 10-year yield, we are going to see, and this is interesting, but I love this fact because I did not do this myself. This is not my chart. I actually don't know who did it internally, but take a look at the breakout. It is very, very clear, an unbiased look that yields are breaking above resistance, suggesting that the 10-year yield is likely to go back toward its old high. So a little bit of a surprise, the fact, though, to Alex's point, that we don't have stocks down sharply, and yields right now up just a little bit, or at least the 10-year yield up a little bit on the day. Stocks are digesting higher yields. Let's see what this repricing of risk looks like. As for some of the individual stock movers on the day, it's very interesting because a piece of the strength of the economy, of course, is strong travel. TripAdvisor, a good report. We have Airbnb, their outlook showing very strong demand. Roblox, totally different area, gaming, but up 25%, incredible, strong holiday demand. And then finally, not so much Biogen. They put up a very strong quarter, but they're saying that the launch of the Alzheimer's drug, Danny, is going to weigh on 2023 profits, so that stock down modestly on the day. But net, it's interesting to see all this digestion as investors work through so many different macro and micro factors.
Gosh, I just still can't get over that screen you showed. Department store sales up 17.5%. Just some really remarkable numbers. I guess a lot of sales-drawn people. And Abigail, thank you so much for the update there. Bloomberg's Abigail Doolittle. Now, it's a little over 7:30 on the West Coast. A beautiful sunny day, I should say. So let's get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. And we, as we are often, are watching Elon Musk. He spoke earlier in Dubai on Twitter's succession plans.
I think I need to stabilize the organization and just make sure it's in a financially healthy place, and that the product roadmap is clearly laid out. So I don't know, I'm guessing probably towards the end of this year would be good timing to find someone else to run the company, because I think it should be in a stable position around, at the end of this year.
Joining us now is Bloomberg Technology co-anchor Ed Ludlow. Ed, I got a million questions just based off of those few seconds of what he said there. But first, okay, he says late 2023, he thinks the company can be stable. How far from stable is Twitter right now? Does that target seem realistic given that?
Well, with Elon Musk, everything is always a sliding timeline. Remember, his skill set's very much to kind of ultimately get there, but he often misses self-imposed deadlines. I think, he described Twitter as a startup in reverse, and kind of emphasis on the financial health of the company. When he kind of started taking the reins back at the end of last year, he talked about the risk of bankruptcy pretty openly during Twitter Spaces, but said that kind of the severe action that they'd taken, reducing headcount from 7,500 people to less than half that, kind of paid off, and actually positive free cash flow generation was kind of more visible after that. So, he's doubling down on this idea that the work's not done on fixing Twitter, that it's too bloated, and you will have seen the media reports about him being in the building at weekends, working in the trenches with engineers to kind of fix some of the platform problems too.
So can I understand, Ed, that if he gets to the point where he can fix it enough to get a new CEO, does he step back altogether? Does he just kind of stay in the background here? Because otherwise, why would any person ever want that job if Musk is literally probably standing there looking over your shoulder?
Yeah, why anyone would want the job has been a question for some time. Remember, Bloomberg reported in December, according to a source, that a CEO search was underway, and that Elon Musk himself, with his advisors, was looking for a potential candidate. This all came about because in the same month, December, Musk tweeted that poll, right? Should I step down as Twitter CEO? And, the overwhelming majority of respondents said yes. So we're waiting to see who that candidate could be. There have been a wide wide range of hypotheses from the kind of Silicon Valley insiders that he was working with in the early stages, like Jason Calacanis, for example, or Sriram Krishnan of A16. So, you know, it's hard to know who would do it. You know, there are some former media executives out there. Sheryl Sandberg's a hypothetical name that there's been no evidence could be real.
Huh, that would be interesting. Well, one person based off of your very own reporting, Ed, who would very much so like to see a new CEO at Twitter is Ross Gerber. What's happening there with him and Tesla?
Yes, my understanding is that yesterday, Valentine's Day, February 14th, Ross Gerber sent a letter to Tesla's brand new corporate secretary and general counsel, Brandon Earhart, basically confirming his ambitions to seek a board seat as an activist investor and outlining the legal grounds and bylaws, Tesla's own bylaws, that would allow him to do so. I've reached out to Elon Musk, Tesla's IR team, representatives of the board, anyone at Tesla that I've got a line into. No one's responded. I wouldn't expect them to. But his grievance is very simple. Elon Musk should spend less time at Twitter, more time at Tesla. Gerber thinks it's a conflict of interest for him to be CEO of both companies, but also, you know, he kind of references the compensation package that Elon Musk has. If you're going to pay a CEO that much, you want that CEO fully focused on the company that's paying you, right? And then that's one part of many grievances that Gerber has, and he believes he's doing this on behalf of the retail investor. Whether retail investors share those views, we'll have to see.
Ed, awesome stuff. Always good to chat. Ed Ludlow, Bloomberg Technology co-anchor, joining us there. All right, coming up, let's go to earnings for a second. GXO Logistics was out with results. They did beat estimates. The stock, though, down by over 4%. We're going to look at the supply chain bottleneck problems, where retail inventories stand. We'll get through all of it with the company's CIO, Mark Manduca. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. China warned today that it will retaliate against the US over violations of its sovereignty, potentially escalating a lingering dispute just as both nations' foreign ministers plan to attend a security conference in Germany. China's foreign ministry spokesman claims the Chinese balloon downed by a US jet had inadvertently floated over the country after being blown off course. China insists that the balloon was a weather monitoring device. Scottish First Minister Nicola Sturgeon resigned after more than 8 years as head of the country's government and independence movement in a surprise move that will reverberate across UK politics.
This decision comes from a deeper and longer term assessment. I know it might seem sudden, but I have been wrestling with it, albeit with oscillating levels of intensity for some weeks.
The decision to step down comes after an unusually turbulent time for Sturgeon and leaves her Scottish National Party and the independence campaign looking for a new figurehead without a clear roadmap. Global News powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Danny.
Ritika, thanks so much. Now, January was a strong month for retail. We know that with the latest data out this morning. It showed that retail sales were up the most in nearly 2 years. For more on consumer demand, we're joined now by Bloomberg's Natalia Knežević. Natalia, what do you got for us?
So one possible way to look at strength of the U.S. consumers is to look at wholesale inventories. So this chart shows wholesale inventories here in the U.S. We saw a pandemic collapse and then a sharp rebound. We also had lots of problems with supply chains. At one point, inventories reached $1 trillion US. Starting from the fourth quarter, we are seeing that the companies are destocking. This is also a signal that consumers keep spending, and we are getting closer to normal levels, which are supposed to be at around $500 billion or $600 billion. So on the micro level, there is one company that we are watching which can provide more insights on how consumers are doing. It's GXO Logistics. They posted earnings. Here's the breakdown. Organic revenue is up by 7.5%. Adjusted EBITDA plus 23%, and adjusted EPS is plus 14%. They did have a slight decline in net income. That was due to restructuring because they had an acquisition. Also, they had a negative impact from FX hedging. But overall, they see that there is a structural demand for warehousing and also a really strong demand in e-commerce. All of that means that consumers keep spending, and at least for now, there is no sign of a recession.
All right, Natalia, great setup. Really appreciate it, Natalia Knežević. So let's get more on GXO results. Joining us now, CIO Mark Manduca. Mark, we're going to get to the sort of the macro effect of that too, but the stock is down 4%, but your quarter was pretty solid. Your numbers held up. Your guidance looks really good. Is there anything here we need to be reading in the details?
Morning, Alex, and I agree with everything that both you and Natalia said. I think it's interesting because, I mean, the shares had to obviously take a breather at some point. I think they're up 21% year to date, but we're incredibly pleased with our performance in the fourth quarter. Natalia's numbers speak testament to it. We had high single-digit organic revenue growth, we had margin expansion, we had strong free cash generation. There was no shortage of things to like. And we're very much looking forward to 2023. This business has 90% revenue visibility and above. So we've got some strong growth coming in 23. We have $2 billion of pipeline and above. And then we gave those 2027 targets, reiterated them today, 8 to 12% organic growth between now and 2027, as well as 17% EBITDA growth annually. It's an exciting time to be us.
Love that. Love that as a way to end that answer. Mark, one of the charts that Natalia showed there was inventories getting back to normal. Everyone is waiting for a lot of the bottlenecks, just for really the entire